Hello, everyone. Jason Gordon, a residential mortgage specialist. Today's topic is understanding monthly mortgage payments. Specifically, when you make that payment, where does all that money go? Now, this topic is essential to comprehend if you're buying a home, especially if you're a first-time home buyer or if you're an investment property purchaser and trying to determine what your monthly cash flow is going to look like. It's also an important concept to understand if you are an existing homeowner who is refinancing into a brand new mortgage. So with any of my videos, I have to give a couple of disclaimers to stay compliant with federal law. My NMLS ID is 259027. Nothing about this presentation or any of my presentations is designed to be an offer to lend or a specific rate quote. So any examples that I give are just examples. And last but not least, I am an equal housing lender. Now, with that in mind, I'm going to do a screen share right now and access an article I wrote on this topic so that you have a visual to follow while we're going through these concepts. The first thing I want to show you here is on the right side of the page is my contact information, how to get hold of me. Again, my name is Jason Gordon. The email address is jasongordonmortgage@gmail.com. The phone number that you see posted there is my cell phone. You're welcome to call or text that number, which is 619-200-8031. That URL of www.vipborrower.com is my electronic business card. I do heavily recommend that you upload the e-card into your cell phone. It's better to know me and not need me than need me and not know me. Once that e-card is in your cell phone, you have hotkeys to get hold of me, to access my social media, my online reviews, my mortgage application, even my mortgage calculator. So vipborrower.com is a great way to keep me in your cell phone. Now, the actual topic at hand here is the monthly mortgage payments. We lenders and real estate professionals as a whole, sometimes we speak our own language. We have a ton of acronyms. I want to call your attention to this acronym here in red font, which is PITI. Everybody who's borrowing money for a mortgage loan has PITI. It's 4 letters, it's 4 words. It's actually 3 parts of your monthly mortgage payment. So PITI stands for principal, interest, taxes, insurance. So section 1 here, as you see, the P and I, the principal and interest, are lumped into one section of your payment. Principal refers to the amount of money that you initially borrow and subsequently pay back. Interest, as we all know, is the ongoing cost of borrowing money. We can all calculate the P&I portion of your payment to the penny once we know 3 variables. The first one is the amortization term, which in this case is the amount of time it takes to pay back that loan. Let's assume it's a 30-year term of repayment. Variable number 2 is the loan amount, which kind of begs to reason. You want to know what your monthly payment is, you have to know how much you're borrowing. And number 3 is the interest rate. Low rates equal low payments, high rates equal higher payments. So knowing those 3 variables, we can get the P&I portion of your payment calculated. Now, it bears noting, this is the only portion of your payment that is impacted by the loan amount and or the interest rate. So a separate visual here, let's look at an example where we have a sales price of $500,000. A borrower puts down 20%, which is $100,000. They're borrowing the remaining $400,000. Let's say it's a 30-year term. Let's say we have a rate of 6.25%. We can see the P&I portion is $2,463. Now, should we change that rate to, let's say, a lower rate, we can see the math get calculated for us to a lower payment. So again, we have access to these calculators on my e-card. You can play with different numbers in different scenarios, but ultimately interest rates are constantly in motion. We want to make sure we're getting the right quotes, so we enter the right math so we can calculate the right estimated payments. Now, that's the P&I portion of your payment. The rest of the items I'm going to show to you today are third-party numbers. It's essential to understand that lenders cannot mark up any third-party numbers. They're going to be what they're going to be, but early on when we're getting you pre-approved, we have to estimate these numbers based on industry standards. So for example, the T is property taxes. Taxes are collected by the local county assessor in the town of which the property is existing. With that in mind, we take the sales price, multiply that price by a mathematical factor, and we get the annual taxes. Well, that mathematical factor can be different in different counties throughout the country. So where I'm based here in San Diego, we tend to use a factor up front of 1.25% when we're estimating what those taxes might be. So let's say we get a price of $600,000 times 0.0125. We have annual taxes of $7,500 divided by 12 months. We're at $625 per month. Now, once we know the property, we may look at county records and see that that factor is lower. We would, of course, at that point, plug in the right factor and get the exact amount of the property taxes. Now, here in San Diego, 1.25% is typically on the high end of the property taxes, unless we have this thing called Mello-Roos. Kind of a funny looking phrase here. Mello-Roos is an example of special tax assessments that are accompanied when you're getting a brand new home or a home that's close to brand new. So let's say it's a new construction, you have brand new paved roads, a brand new school district, a brand new fire station. All those locals are helping to pay for that new car smell in the form of Mello-Roos. Now, the terms of Mello-Roos can be different throughout different communities, through different associations. Always check with the home builder who's selling that home to determine what the specific Mello-Roos numbers are for your situation. Okay, so just kind of keep that in mind, that if Mello-Roos is present, you want to make a mental note that you're going to be paying more in that section too. Moving on to the I, the homeowners insurance, also known as hazard insurance, also known as fire insurance. Quite simply, lenders are going to require that you have homeowners insurance. I can tell you now that even if you didn't have a loan, didn't have to answer to a lender, you still want to have insurance because things happen, right? Fires, floods, other catastrophes. Lenders in this case are going to require it when you have a mortgage on that property, because after all, and this sounds kind of harsh, but that home is collateral for repayment of that loan. Should that home burn down and the collateral become a pile of ashes, the lender wants to know that an insurance company is going to rebuild that home so that that collateral is present again, so the lender can reinforce their ability to get that money repaid by you, the borrower, over the next, rest of that 30-year period. Now, insurance is always going to be estimated upfront by a lender, knowing that we're not the ones writing the insurance policy. There could be vastly different amounts of insurance based on your deductibles, based on whether the home is in a fire and or flood zone. Are you bulking the homeowners insurance policy with your auto insurance, right? What are your deductibles? So we are going to always estimate those numbers up front, but you do want to let the lender know if the property is in a fire and or flood zone so that we can alter those numbers, because in the end, we have to calculate the correct numbers. Let us know if you're going to be buying in a flood and or fire zone. Now, everyone has PITI as part of their qualifying numbers when they're getting pre-approved. Whether or not you're paying the TI separately or as part of the PITI, oftentimes is up to you depending on what kind of loan you're getting. Now, if you're paying the PITI all in one payment, you're essentially paying 1/12 of your annual property taxes and 1/12 of your annual homeowners insurance as part of your payment each month. That T&I portion of your PITI payment gets deposited into what's called an impound account, which is also known as an escrow account. Think of that escrow or impound account like a slush fund. Every month you make your PITI payment, the T&I portion gets deposited into that slush fund, which grows higher and higher each month. Now, twice a year, the lender will pull from that slush fund on your behalf and pay your property taxes when they're due. And then once a year, the lender will pull from that slush fund on your behalf to renew your homeowner's insurance policy. So whether you have an impound account or not, just know that the lender is going to use that PITI payment when calculating your approvability on your loan application. Now, some folks are going to have a couple of other possible entries on their monthly payment. For example, we have PMI. I realize PMI sounds similar to PITI. PMI is private mortgage insurance. This is where you have less than 20% down on a conventional loan, or you have the equivalent of PMI in what's called an FHA mortgage, where essentially you're paying extra money on your monthly payment to insure the lender against any loss should you not pay them back in the future. So PMI, if you have 20% down or more on a conventional loan, is a non-factor. If you have less than 20% equity in your home, PMI is a factor. It's most often paid per month. This is why you see it in the context of this lesson. Sometimes it can be bought out with a one-time buyout. There's different options available, but more often than not, if you have PMI, it's part of your monthly mortgage payment. And then last but not least, should you buy a condominium, you're going to have homeowner association or HOA dues each month. Now, those are paid directly to the HOA, just like any utility bill, but the lender is going to calculate your HOA dues when they calculate your ability to get approved. Now, those HOA dues could be $200, it could be $1,200, depending on the HOA itself. So keep that in mind and make sure you let your lender know. If they have you pre-approved for a single-family residence with no HOA dues at, say, $600,000, and you buy a property for, say, $580,000, but it has $600 a month in HOA dues, that approval might not be present because you have to calculate the math on that monthly payment into your monthly debt to income ratio. So HOA dues are going to be calculated as part of that payment. Bottom line, the more you let your lender know what you're looking for, the specifics of your goals, the more you're going to have that lender ideally be of help to you. That is a conclusion of this topic. Again, my name is Jason Gordon. My contact information, I'll put up on the screen one more time here. Feel free to reach out to me whenever you like. I do appreciate your time, and I look forward to hopefully speaking with you soon. Take care. Bye.